Hello and welcome to Vox Markets. I am Johnny Human and I'm delighted to be joined today by Jamie Constable of Singer for our first macro catch-up of the year. How are you doing, Jamie?
I'm great, thank you, John. Good to see you and Happy New Year.
Yeah, Happy New Year. It was a horrible 23 to sum it up in a very short statement. But we seem to start the year with a little bit of optimism. There was a little spike in inflation this month, but you don't think there's much to worry about. Give us a sort of feel for what's going on there.
Yeah, I think we had a good December. Markets got squeezed, which is what we could see happening this year as well. Let's go to that CPI. We had that spike, the December number that we had out in January, 0.4% month on month. I think the key on that is if you look back over the last 7 months, month on month data, and then annualize that, even with that 0.4, you're only looking at annualized CPI at 1% in the UK. So I suppose that raises the first question: is why isn't the Bank of England going to be cutting rates? Well, partly because they're looking backwards rather than forwards. But I think what we do need to be aware of first is that what's going to happen on February the 14th. Hopefully not a Valentine's Day massacre, because we are going to get another spike. I don't think people have put numbers to it, but I've done some work on this. The January number, and it gets a little bit technical here, you're going to get minus 0.6 dropping out from January 2023. So that's the year-on-year impact of dropping out. Plus, you got the energy price cap increasing by 5% on the month. When you put those two in, you could get a high 0.9, even 1% increase month on month in inflation. So from 4, and on the day we had that 4 last week, we saw the equity market up 1.5%. But it has rallied back since, importantly, those interest rate sensitive since. On the February the 14th, we could see it spike from 4 to somewhere close to 5. Now, it's the extent the market understands that, I think, is important. But of course, that's really short-term data. But I think, the question for the viewers is, to what extent do you think the market understands that it is just a short-term spike?
Well, I think that sort of jump that in the sort of December number that we saw last week and the reaction of the market suggests that there's still a lot of short-termism in the air.
I think there is. I think everyone's running on the latest data, the data that hits the screen, what's going to happen. This week, you've got the US PCE, which is, of course, the Fed's favoured measure on Friday. And that will say should be quite a good number. And again, raise the question of why aren't the Fed cutting yet? And we think they should be cutting it. They will cut in March on their meeting on March 20th. And talking about short term, yes, it does bring us back to that February the 14th number and what happens there. But I think what's really key for the UK is that come April, we get yet another energy price cap setting. Now, this winter, we haven't seen the spike in gas prices that typically you would expect through the winter, mainly because the stocks haven't been run down across Europe and they're seen as plentiful. Maybe that's partly because obviously industry is not exactly booming at the moment. Anyway, what does that mean come April when we get the April CPI? We're looking at somewhere between a 14 to 16% drop in the energy price cap. If it was 14%, that translates roughly to minus 0.6 on CPI in April. That means that CPI on my forecasts and the Singer forecast that we're looking at could be well below 2% in that April reading. So quite a complicated picture. We get it potentially moving up to 5 on February the 14th when we get the January number. But that April number, which will come out in May, but of course the MPC, or the Bank of England, when they have their meeting on March the 21st, somewhat coincidentally the day after the Fed meeting, we'll be able to see that CPI number for April. And they can see that it will be substantially below their 2% target on the numbers that we calculate. So on that basis, looking forward, rates should be falling. So once we get through that the February announcement on UK CPI, it really does plummet in the UK, the CPI reading.
Yeah, so it's all very good news further down the line, for consumer confidence, for market confidence. I mean, there is one lingering worry in the short term, and that's what's going on in the Middle East, particularly the Red Sea, which has been spoken of as potentially inflationary. What are your views on what's going on there?
We've asked a few companies about this. We had one company, consumer goods company, last week. We're asking about it. It's an extra 10 days, maybe 2 weeks going around South Africa. The container companies, obviously, the shipping companies have put the prices up. but it's per container. And when you obviously net that out against the goods within that container, it actually doesn't calculate out at too much. Also, it's a low point of the year now for shipping goods, January. So there's not a massive amount on the water. You've seen it in the, if you were going to see a big increase, you'd expect to see it in the oil price. But actually, the oil price, it keeps having a look at $80, but it won't go through it, partly because there's plenty of production coming through from the US. But you would see it in those short-term markets, but also in the gas market as well, because a lot of the gas comes from Asia as well. So we don't see it as a particular worry at the moment. If it got worse and the conflict got worse, we'd have to recalculate and look at that. But actually, in terms of numbers and impact on inflation, we don't see it as particularly bad. And also, as we just talked about, you've got that massive fall in the energy price cap to come through in the April CPI. They'll announce it the first few weeks in March, so we'll already be with people there. So we don't see it as a problem in the short term, but we do need to keep a close eye on it, because if things were to blow up any further, then, no pun intended, if they blow up any further, then we do need to put that into our calculations.
Yeah, just so to keep on the watch list then for the time being. But generally speaking, we can expect consumer confidence to improve as interest rates fall, and we've potentially got some interesting political events that are coming throughout the year, which could further help sort of shore up consumer and business confidence. Talk us through what's coming. What would you see the outlook for consumer confidence as, and how, as I say, these political events could play into that?
Yes, well, remember last year we did our proprietary work on how the returns on interest income on savings substantially exceeded the increased cost in mortgages, increased mortgage costs as people took on mortgages. That wasn't equally distributed across the economy, of course, and people who had a lot of debt would be still suffering. But for the people with savings, it was very positive. We recalculated that number in December, and it had increased. Why did it increase? Well, saving rates have gone up. People have moved money from non-interest earning accounts into interest earning accounts, and importantly, mortgage rates are now falling. So instead of 6+, you can even get below 4 now, depending on what your deposit is. So positives there. Other positives for the consumer, just before we go on to the politics, you've got minus 2% off your national insurance in January. Talking about elections, you've got a 6th of March UK budget. I don't know about you, but I think it might be a giveaway budget.
I suspect so. Victoria's got a lot of work to do.
They're already talking about tax cuts, aren't they? It's just what cuts they put through, and you would think they would do something on income tax or something along on that nature. So there's that. Then, of course, you've got the living wage going up by 9.8. You've got pension, it's going up by 8.5. So that's all pretty positive for the consumer. And for the consumer, all that adds up to improving consumer confidence. We are still much more positive on low-ticket consumer, going to the pub, going out to a restaurant, or going bowling or something like that, rather than high-ticket. We're still cautious on high-ticket, apart from the house builders. Why the house builders? We're positive on the house builders because they're the natural macro sector. Markets move ahead of events, so we're positive on the house builders because of that. But we'd still be a bit cautious on high-ticket items. So, you're going to buy a car, are you going to buy new furniture, RMI and things like that. I think we need to see the first interest rates coming through before we're more positive on that area of the market.
Yeah, absolutely. Well, you'd imagine with the house builders, there's a fair amount of pent-up demand after the kind of big drops in housing completions last year. But we did see, over sort of December, some pretty horrible retail numbers. So that confidence isn't sort of flowing through just yet. What's your reading on that?
I think what happened there is you saw a lot of demand brought forward into November. If you think about Black Friday it now seems to start on the 1st of November. So I think a lot was brought forward. Some retailers put their prices back up in December to try and make up. I think, as we just said, it's not every consumer is feeling better off. If you've got a lot of debt or very high mortgage, you're probably not feeling so great. But on the other side of it, look at holidays, there's a lot of spending there, and that was a lot better. But it's that low ticket we're more positive on. If you look at Next put out a strong statement. If you look at Marks put a strong statement out. So we still have got a lot of our winners out there to invest in, I think, very much so. I think I think what you've got with the end of free money, if we think back, we had free money for 13, 14 years. That's over now. It's now about stock selection. It's about picking the best stocks. We do need to remember that the UK economy is still flatlining. We're not talking about 2-3% GDP growth just yet. The economy is flatlining, so you need to pick the quality management teams who can deliver, and there will be hiccups within that.
Yeah. I mean, there was a lot of people buying a lot of stuff. Certainly during lockdown, we did see something of a consumer boom, particularly online. A lot of that does seem to have sort of reversed. Do you think there's been a shift from buying stuff, from physical goods to the more sort of experience service based
I think,
type of purchasing? You mentioned holidays as an example.
I think definitely you've seen that. If you think about, someone who's retired, who's got savings, they're time rich, they can go on holidays. So if you look at what happened in that December CPI number, part of that was that airfares stayed high. There's a lot of potential supply coming on through this year, so we'd expect airfares to start falling back again. But yes, I think people are looking for that experiential stuff. Yeah. I think there's other sectors though that we are positive on, and for the year ahead though, very much so. It's interesting that ex the US and China, we see GDP growth accelerating second half on first half. The big question being, when will the UK election be? It does look more like the autumn now. Maybe we think they should probably go May, June though, based on the data, but they'll want to wait as long as they can. So other sectors, it's a quadrennial year. If you think about that on advertising, you've got we just mentioned the US presidential election, the UK general election. You've got the Olympics. You've got the European Football Championships. Now, this is a year when ad spend, which has been depressed, should be picking up. And if you think about interest rates falling and consumer confidence and company confidence, importantly, picking up, then we'd expect ad spend to pick up this year as well. And there could be one more downgrade in that sector on the stocks. But what's interesting in equity markets at the moment, and I'm sure you've seen it, in what you've been talking about on your morning calls and stuff, is that investors are starting to look through the downgrades. They're looking for that last downgrade to buy the stock. So that's very much a feature now, I think, that we're starting to see in markets.
Yeah, let's hope so. We had some pretty horrible numbers again from S4 Capital this morning as an example of that. One other sector that's had some pretty horrible updates recently is recruiters, and this again, it seems to be at odds with what we're seeing in the economy, that services is a lot stronger than sort of manufacturing. What's your read on sort of the white collar recruitment picture in particular?
Yeah, it's confidence basically. It's confidence. What causes recessions is confidence and a lack of confidence. People retrench, they stop spending, and then you start to go into that downward spiral. So that's why the central banks will be moving into interest rate cutting scenario. We see that confidence picking back, or there should be. The risk to everything we're talking about is that the central banks act too late and don't get moving on those interest rate cuts. But what's causing it, if you look at the Michael Page statement, for example, Hayes as well, it's a confidence. There's plenty of vacancies out there and jobs out there, but it's on both sides. Companies are feeling a bit less confident, so they've got people maybe ready to take a new job, but they're not willing to press the button. But at the same time, people aren't willing to move jobs because the old adage, first in, first out. If you see a downturn, if you're the last to join a company, you could be the first out the door. So I think that's what's happening. So then, as we move into the upturn in the cycle, interest rates are cut, confidence picks up. And don't forget, there's still over 900,000 vacancies in the UK economy. That's a big, big number, 900,000 vacancies out there still. Then we will see see that market starting to free up. And the transactions, the job moves will start happening. And there's an old adage in the market: you buy the staffers when they're on high multiples, like high PEs, and you sell them when they're on low multiples. And if you look at the sector now, they've moved up because of those downgrades to high multiples. So certainly a sector we think is worth a look at.
Yeah, absolutely. You mentioned something quite interesting there, a word that perhaps falling a bit out of fashion: cycle.
Cycle, yes.
I know you've got some strong views on this.
Well, we think the cycle's back because we had 13 years of free money, and let's be honest, free money, everything went up. It was just a case of when it went up, because there was always something coming back. The cycle will be back now. If you look at the Begbie's Trainer red flag report today, a lot of companies. It sounds a big number, but there's a lot of companies in the UK. A big pickup in companies in trouble. But what we're seeing this time around, positive with interest rates where they are, is that those companies, the banks, are confident enough to say, unfortunate for that company, but those zombie companies that have been going on for a long time are going into receivership or insolvency. That makes it better for the surviving companies because they can earn a higher margin, higher return on capital, and they will invest. One of the perverse impacts of free money was there was underinvestment in capacity. And that's, again, we're positive on capex-led stocks because you've got reshoring, nearshoring, decarbonisation, add that all up. But yes, we think the cycle will come back. So the old charts, like there's a kind of, I like to put it, a Wheel of Fortune, which you can find on the internet. I don't think it's called that though. But if you look at the economic cycle and the investment cycle, then we think, yes, it will come back. So now you'd be looking for those early cycle industries to invest in. So that's why consumer cyclicals moved. They performed very well in Q4 last year. And then it moves into technology and healthcare, not healthcare staples like the large drug companies, because you see confidence picking up. Bond yields might fall, though one thing we got wrong last year was very much that bonds fell. Bond yields, particularly in the UK, fell a lot further than we thought they would. So I came back from holiday in December and couldn't believe that the UK 10-year was at a 50 basis point discount to the US 10-year. And that's closed in quite a lot now. And I think we think around forwards about right. It might go a bit lower in the UK if we see inflation falling like we think. But actually, you'll probably see what will happen is that the yield curve will steepen quite sharply, with the short end coming down and the long end maybe staying up a bit higher.
Yeah, fantastically positive for equities too. Well, it's a great way to start the year, Jamie. Nice talking to you, and nice to start 2024 with a bit of optimism.
Yes, we're very optimistic. Thanks, John. Great to speak.
Thank you. You too.
Cheers.
Thanks.